let's of course kick off with that ICC ruling. It seems that the market has shrugged off that ruling, investors and analysts saying that it was largely priced in. Do you see it have any repercussions for the market today?
I think the reaction from Kenyans, and especially from the volatile areas in the country, these are the areas that experienced the post-election violence in 2007, 2008. The reaction was, wonderful. It was peaceful. The government had put in measures to prevent any violence, but Kenyans basically just went about their business. Yes, the risk had been priced in somewhat, especially this was seen in the equity market. And also we saw the FCY market also a bit anxious about the decision. But the country reacted beautifully. People are moving forward. Of course, there is a bit of noise from one or two societies within the country. But basically, we're moving forward and waiting for elections in 2013.
Yeah, which is definitely a positive for the market. Let's focus in on the bond market at this point in time and government's borrowing position. The sale of that one-year bond ends today. It's looking to raise 10 billion shillings worth. Do we know the type of appetite that is likely to have come through for that and the coupon that it's going to be sold at?
The market is pretty liquid. January had quite a high number of maturities, almost 47 billion. And that's based on T-bills and T-bonds. So with this T-bond for 10 billion, January has maturities for bonds for about 9.9 billion. This should be covered by what CBK will pick from the market. So we do expect they may accept slightly more than what they're looking for. They may go up to levels of 12 to 13 billion. Because there's a lot of market appetite. And also it seems that market sentiment, people have started bids are becoming more reasonable, as we saw last week with the 91 and the 182 T-bills. Market averages are coming down, so we think we've hit a plateau, especially on the short end. And as to the coupon, which will be market determined based on the market average, we're looking at levels anywhere between 21 and 22%.
Talking about the yields, which appear to have plateaued, what is a signal about inflation expectations in the market right now?
We expect inflation may come off further in January. We expect the figures will be out early next week. So this is actually filtering through to interest rates. People are already pricing this into their bids. So I think that's one of the major reasons behind the plateau we're seeing on the short end.
What do you see as the key risk factors? Of course, oil, we know that is a big concern given the high demand for fuel imports and, of course, forex to sustain that. But from your perspective, in the next 6 months, what do you see as the biggest risk factors to the inflation rate coming down?
I think food is the biggest factors. The meteorological department had predicted the first 3 months will be very dry. So food would be the biggest factor. And also, when you talk about the weather, of course, since Kenya, most of our electricity is generated through hydroelectric power plants, this is also a big threat. We may see some pressure coming on energy prices, which have come down. Of course, if global oil prices hold, and although most analysts are expecting them to rise during the second quarter of 2012. So I think the biggest threat to inflation would be energy and food. And especially in this first quarter, January, the end of December and the end of January actually saw frost in most of the crop areas. These are the short-term crops such as tomatoes, onions. So that frost really cost a lot of the farmers. We've seen a slight rise in prices of these the short crops, basically, that take about 2 to 3 months to grow.
Whilst yields on the T-bills appear to have plateaued, do you believe that interest rate hiking cycle has plateaued as well?
Yes, I think I don't expect the MPC to hike interest rates anytime soon. In fact, we may see it coming off slightly. That is going into the third quarter. Of course, in the first 2 quarters, we expect them to hold the rate where it is. And if factors remain constant, and if we do get the 600 million syndicated loan, that will actually be, for the domestic borrowing budget, that will be almost half of what we're looking for, because the financial year 2011-2012 was looking for about 119 billion. $600 million basically works out to about 55 to 54 billion. So we'll be halfway there. And I think that should also ease pressure off, upward pressure off the rates.
So, of course, you're looking for a cut possibly coming through in Q3. You've mentioned that $600 million loan with the remaining 57 or so billion shilling gap that government still has to plug with regards to domestic borrowing. How do you see it plugging this gap right now, and is it a concern?
Especially from the domestic borrowing market, the government is has done about 1/4 of 25% of what they were looking to do in this financial year. So put in the $600 million, and I mean, we're almost there. And the government has hinted at other sources of funding. So, and Treasury seems quite comfortable with how far we are in the domestic borrowing budget for this year. So I think, I mean, they look comfortable, they're not worried. I do think there'll be other sources of funding which they have not disclosed and which we may learn of later.
Whilst we've had yields ticking down on the primary market, do you see the same thing filtering through on the secondary market? And just take us through trading activity that's been taking place on that front.
We actually have seen this filtering through to the secondary market. In fact, it actually began in the secondary market before the primary market. The last, I'd say last 10 days has seen immense demand. Actually, not even 10 days, 14 days has actually seen immense demand for short papers. The 2-year paper, which at the beginning of January was trading at levels of 21.50 and above, almost 22%, has come down to trade at levels of about as low as 17.5%. I mean, there's immense demand in the market for short-term papers, medium-term, and also we're seeing insurance companies and fund managers coming in looking for long-term papers. And what we're seeing from investors is most people are holding off selling at the moment. I mean, market sentiment is that trades are coming off. So holding off to see how far rates can come off before you can exit positions. So demand is quite heavy in the market. There's a large demand overhang and no supply actually across the whole curve.